All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy for investing in real estate. So if you've been researching life insurance and real estate investing, you've come to the right place. So please be sure to bookmark and like this video so that you're notified whenever I come out with new videos. You're definitely not going to want to miss any of the new videos that I'm coming out with. Today, we're going to be debunking a common life insurance myth, and that is that the insurance company keeps the death benefit when you die. And if you've been doing any research, you may have come across a pundit who said that, oh, you don't want to buy life insurance because then life insurance company is just going to keep the cash value when you die. That shows a tremendous misunderstanding of how life insurance works. So if you really want to know what happens to the cash value, stick around after the intro video and I'll break it all down for you. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies, and I created the Double Play channel because I know how hard it can be to research life insurance online. There are websites that tell you you should invest like the Rockefellers, but you have to talk to one of their sales agents to find out exactly how that's done. There's a lot of fluff and light content, and again, you've got to give up your email address in order to get that content. So my goal is to put all that content out there for free. I know that you want to know, is using life insurance to invest in real estate better than just simply taking your money and investing directly in real estate? And that's what I want to show you with this channel. So my goal is to give you everything that you need to know without ever talking to a life insurance agent. The only time you should ever need to reach out to an agent or to me is when you need to see what the numbers look like for you, when you want to see an illustration of what the business model looks like for you. And if there are any questions that I haven't answered in the video, please be sure to put them in the comments, or just put any questions that you have in the comments. I usually get to those comments fairly quickly, and the answers will certainly benefit anybody else who's coming along after you. And who knows, it may give me the topic for another webinar or a video at a later time. All right, before we get started, let me cover my standard disclaimers. There is no tax advice, no legal advice, no financial advice. All of this information is purely educational in nature. And the primary purpose for life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, we got that out of the way. And while we're at it, a lot of what we're going to be talking about today is pretty technical. So if you need some more information, I highly recommend downloading my Life Insurance 101 ebook. And while you're at it, you may as well grab my ebook on the Double Play. Both of those links to both of those are available in the description down below. All right, let's get started. So the goal of today's video is simply to show you that the insurance company does not keep the cash value when you die. That statement just shows that whoever made it doesn't understand how life insurance works. So what I'm going to do in this video today is just straight up answer the question, and if you are happy with that, you can stop. You won't break my heart. But if you want to understand the answer with more detail, I'm going to go on and I'm going to give you a little bit of background so that you understand what the cash value is and represents in a policy. I'm going to give you some examples of how the cash value works in a traditionally designed life insurance policy and in a maximum overfunded life insurance policy. And then I'll wrap things up. So let's go into the first section, which is, what's the quick and dirty answer here? And the answer is the insurance company does not keep the cash value when you die. The cash value is an integral part of the death benefit. It's quite literally the policy owner saving up the death benefit for the insured over the insured's lifetime. So as a result, it's part of the death benefit. It's something that you have access to and you can use while you're alive. But to think that it's some sort of separate savings account that the insurance company keeps, that's just ridiculous. All right, so at this point, if you want to tune out, you're not going to break my heart. But what I'm going to do now is just go on to cover the life insurance 101 so that you understand the cash value. And then two, I'm going to cover examples of what this is going to look like in a traditionally designed life insurance policy and in a maximum overfunded life insurance policy. All right, and I think that the easiest way to explain life insurance is to start with the example of a 45-year-old male who wants to buy a life insurance policy with $1 million death benefit. And when you buy a permanent life insurance policy, the insurance company wants to give that death benefit to you at the lowest price possible because they know that there is going to be competition. And most people that buy life insurance want to get that death benefit for the lowest price possible. So they're going to be shopping it around, looking for quotes from several different insurance companies to see who offers the best rates on that $1 million. Now, from the insurance company's perspective, they have two considerations that they need to make. One is not every 45-year-old is going to make it to 46. So they need some money to put into a pool to cover all of the expected claims for all the 45-year-olds who aren't going to make the 46. And by the same token, they want to include enough premium or cost recovery so that the policy owner saves up the death benefit over the lifetime of the insured. So that's the cash value of the policy, or the reserves of the insurance company, more technically. So I want you to understand that this savings mechanism is the cash value of the life insurance policy. So over time, there is a risk transfer from the insurance company who, in the very first years of the policy, they're on the hook for that entire $1 million death benefit. But over time, the cash value is going to grow and slowly but surely come closer, ever closer to the death benefit. And the last thing that I want to add here is that everything I've just told you applies equally to both whole life and indexed universal life. There are many agents out there who think that somehow under the hood, whole life is doing something different from what an indexed universal life is doing. But that's not the case either. The basic function of a permanent life insurance policy is exactly like I've described it here. All right, so let's go on to what the cash value looks like in a traditionally designed life insurance policy. Most people are buying death benefit protection. So again, they want to get it as cheap as they can, and the insurance company is going to be collecting as little in premium as it can possibly collect in order to perform on the obligations that they've committed to in the policy. But their concern is also keeping the premium low so that they don't lose the business to another competitor. So let's take a look and see what the numbers look like. All right, this is an example that I've used in many of my videos. You've probably seen this before, but this shows both the death benefit and the cash value in a maximum overfunded life insurance policy. The orange line at the top at the 1 million mark is the death benefit, and the blue line represents the cash value. And you can see that the cash value starts off very low in the beginning, and it grows and eventually reaches the death benefit somewhere out around age 115 or so. Now, all of the space between the death benefit and the cash value represents the net amount at risk to the insurance company. Now, all insurance companies work by pooling risk. So the premium that they charge needs to include enough money that they can put into a pool to pay all of the expected claims on those 45-year-olds who aren't going to make it to 46. And at the end of the year, the process begins all over again. The cash value has grown a little bit, and the amount at risk to the insurance company has gone down a little bit. So cost of insurance is going up over time, but the net amount at risk is going down over time. That's the main takeaway here. The main thing here is that at any given time throughout the life of the insured, you can see that the insurance company has a mechanism by which they can pay the death benefit. So most people are buying death benefit protection because they have an immediate need for it. But over time, as their savings goes up, they don't need the death benefit protection as much. Everybody could save up their own death benefit, like to have enough money to pay all your bills, pay the mortgage off, whatever. But the risk is like, what happens on day one when you first start saving and you don't have all that yet? That's the risk transfer to the insurance company. And the cash value represents that risk transfer from the insurance company in the beginning to the insured over time, because they could have saved up all that money outside the policy anyway. The real risk is upfront, and the insurance company is taking that risk away from the policy owner. All right, so now let's take a look at the cash value in a maximum overfunded life insurance policy. Now, when someone purchases a maximum overfunded life insurance policy, their concern is not so much the death benefit, but it's the cash value. They want to get as much cash value for every dollar of premium that they're paying into the policy. So we're designing what's called a minimum non-MEC, or maximum cash value and minimum death benefit policy. So let's take a look at the graph and see what this looks like. All right, here you can see that there are two curves that look like they're very close together. Again, one is the death benefit, $1 million. It starts at $1 million, just like it did in the other graph. And the premium is much higher at almost $48,000. So the cash value is literally pushing up that $1 million increment throughout time. And that's how a maximum overfunded life insurance policy is designed. Because the cash value accumulates to over $30 million by the time that person would reach age 120, you can see that it's not fitting. It's making the gap or the delta between the death benefit and the cash value look much smaller than it would be comparable to that earlier illustration we just looked at. But one thing is the same. Once you get out toward your client's natural life expectancy, let's just look at age 89 on the graph. You can see that right here, the death benefit is just shy of 10 million, maybe around 9 million or so. And the cash value is just 1 million less than that, at about 8 million. So just as in the earlier example, the cash value and the death benefit are very close together. There's as little risk as possible in this policy design. You couldn't get any less than that and still call it life insurance. That's my overview of cash value in a minimum and maximum overfunded policy. In both cases, again, I just want you to understand that the cash value is an integral part of the policy, and every bit of it makes up the total death benefit that's paid to the beneficiary when the insured passes away. So just to wrap things up, again, the goal of this presentation was simply to show you that the insurance company does not keep the cash value when you die. Anybody who tells you that or states that or makes that statement simply doesn't understand how life insurance works. So that's all I have for you in this video. If you're hungry for more information and you don't want to talk to a life insurance agent yet, I highly recommend going out to Facebook and joining my Double Play group there. That's a community of like-minded people who are interested in learning about using life insurance to invest in real estate, or they're doing it themselves. In either case, go there and ask questions of the membership. There's usually plenty of people there who are eager to answer your questions and can chime in, share their experiences. In addition, there's just a ton of information available on my websites. There's a corresponding blog post that accompanies almost every one of my videos. So you can find that on the website and print that out, so you have not necessarily a transcript, but something a little bit more detailed than what I cover in the videos. And finally, if you want to help this channel financially, feel free to buy me a coffee. The link is in the description for that. Any support is greatly appreciated and gives me an incentive to keep on providing these videos for you. So with that, I will see you in the next video.